Good evening, everyone. Thank you for joining us in our fourth live webinar designed at helping you manage through the COVID-19 crisis. Tonight we have a fantastic guest in Heath Stewart from Ecovis Clark Jacobs, an accounting partner of ours. I'll run through a bit of an introduction for Heath shortly. On the line, we also have Tal Eloss for One Property Group. Tal's going to join us for the Q&A session tonight, and he can answer any questions you might have around property that come up from tonight's presentation. Just before we do kick across, on the right of your screen, you will see a chat function. You can log a question at any time through the chat function, and we'll endeavour to get to those questions at the end. We'll only keep you for about 45 minutes tonight. I think Heath will talk for about 20-25 minutes and then have enough time for Q&A afterwards. If there are any questions that you do have that we haven't had the opportunity to get to, we will contact you afterwards and answer those questions. So Heath Stewart is the director of Ecovis Clark Jacobs, an accounting firm with over 20 years experience advising clients in the medical, dental and veterinary fields. With clients ranging from undergrads through to household name corporates, Ecovis Clark Jacobs consults on a variety of business matters for healthcare professionals, including setup, buy-sell transactions, benchmarking and practice consulting. Heath works with his clients, tailoring advice to each client's specific needs, such as assistance with industry KPI comparison, forecasting projections, financing and efficient tax structuring. And as well as this, Heath supervises the firm's audit and assurance engagements, including litigation, support and valuation. He's a regular presenter at seminars for practitioners in both Australia and New Zealand, and he also regularly contributes articles on taxation and practice management, and is a long-term contributor to the Australian Dental Association magazine, Newton. So it's fantastic to have Heath here joining us tonight. He's going to talk to us about preparing for end of financial year and managing your cash flow. And on that note, Heath, I'll throw across to you.
Thank you very much, mate. Actively to encourage everyone as well, on the right-hand side of your screens is the Q&A, the chat tab, I should say. At the bottom of that is also a little toggle button which makes sure you're sending the questions to everyone. Please remember as well, a lot of these online webinar forums are not the most secure in terms of that from a technology perspective. So don't use specific information, specific names and things like that. Keep the questions general. Also ask as many questions as you like. The only silly question is the one you don't ask. Because if you're thinking it, I'm sure someone else is, and Tim will facilitate that through the evening and sort of jump in with any questions that people may have. Now, I'm going to run through my slides now, and we're going to do a couple of things tonight. I'm going to talk to you about just the general coronavirus economic stimulus package from the federal government. Most of you should be aware of the ins and outs of this and how it applies to your practice. And then I'll step through some examples on the sorts of things that you should be doing in your practice before 30 June, some critical things. Now, also just one other bit of housekeeping. On some of these slides, you will see a QR code. Now, what this will enable you to do is download that slide through to your phone, which will enable you to look at a PDF of these documents later. Of course, if anyone's got any direct questions and they would like to engage with us separately on any item, please just contact us or Tani, and we can sort that out for you. Just as a bit of a recap in terms of the overall JobKeeper program. So in terms of the cash flow boost program, look, to recap on that, that means that effectively if you or your practice or one of your practice entities was employing staff and you had filed BASs previously prior to the announcement of the legislation, then you're eligible for up to $50,000 worth of credit back on PAYG you withheld on staff, or payments to yourself or your spouse up to 30 June, and then another $50,000 after 30 June and the first quarter next year. In relation to many people who are utilising single touch payroll and have filed their business activity statements already, have already received their first tranche of the cash flow boost payments. This is the first part of the legislation that was enacted. The tax office are the administrators of this program. They're doing a very good job. an enormous amount of these payments have gone out to practices already without even filing BASTers. So a lot of those practices on single touch payroll have already received this. The JobKeeper program, in terms of the application on that, so the JobKeeper program has created some challenges. The sense, of course, is that there are many practices that had staff that were only recent casuals, staff that had been employed after the legislative announcement date, staff that were on the wrong type of visas over here that haven't been able to access the JobKeeper program. In terms of that, though, the program notwithstanding, and also there's sort of people that have, some staff that have actually ended up getting a pay rise as a result of the JobKeeper program, which is perhaps not the intention of it, but again, that's just been the broad application. We're seeing that, again, mostly the practices that are reasonably well established, that have got good systems, good compliance, good lodgement history, those practices that have got their paperwork up to date are already in receipt of JobKeeper payment for their eligible staff. A big difference, of course, between JobKeeper and the cash flow boost payment, JobKeeper, of course, is accessible. So it's important to note that if you're getting the JobKeeper payment to reimburse your staff wages over this period of time, then that reduces the cost of your wages outgoing. So that income those payments are actually due to going to be assessable income. In relation to industrial relations reform, look, I'll touch on that very briefly. I would encourage any of you here to contact the AMA, ADA, ABA, and talk to their industrial relations or HR line. Suffice to say that you can't make people take a pay cut. There's a whole lot of things you can't do. Anything that was unfair dismissal prior to all of this media and all of the legislative changes is still illegal. So in terms of this, you can stand people down to the JobKeeper payment threshold. You can ask staff to work reduced hours as a result of that. You can ask staff to take a pay cut, but in terms of that, it requires their consent to do so. So in terms of that, I'd encourage you to just reach out to the various associations or your accountant in relation to this. Every scenario and circumstance is different. One other thing as well is that it's important to note when you are making some difficult decisions in relation to staffing and recruitment at the moment. If you do have to drop staff and staff do have to take reduced hours or pay cuts or things like that, then the offset on that is that the staff member is eligible for early access to up to $10,000 of their superannuation, as are you as a practice principal in some circumstances as well. Now, in terms of that, people accessing some of their own superannuation money to keep them going, well, again, I say this as a taxpayer, it's probably fair enough that some people are spending some of their own money at the moment. But it's important to note as a consideration that if you do have some concerns about the well-being of your staff, as of course many of us do, then the standing down or having to make redundant or let staff go, it will mean that they will get early access to their superannuation. One of the things that I would like to I'm going to talk a little bit tonight about as well is the increase in the instant asset write-off. Now, many of you would be aware that prior to the release of the economic stimulus package, then that a practice would be eligible to an immediate write-off of money that they spend on equipment, so long as that invoice amount was less than $30,000. This has been increased very substantially to $150,000, which is a very big number. And in terms of this is a throwback for those of us who can remember the GFC. Prior to the GFC, what happened is that typically, if you were setting up a practice and you were spending several $100,000 on that practice, then you had to put all of those costs on your balance sheet and then depreciate those costs over, in some cases, as much as 20 years. Now, what happened through the GFC is the law in relation to depreciation was changed, and that allowed practices to write off equipment. At that stage, the amount was $10,000 immediately, and that was a great success for the Australian economy. It was a a great boon to, I guess, a lot of different industries. And in terms of that, what we're seeing is that the government trying to replicate what was successful through the GFC. Now, in terms of this, $150,000 though is a lot of money. And what I would say, and I'll talk about this a little bit more later, is that you need to be careful if you're going to spend this much money or borrow that much money. And of course, there is another requirement that you can't just have spent the money and not have received the asset. It needs to be plugged in, as it were. Now, we suspect that the $150,000 instant asset write-off, look, we suspect it's going to be extended past 30 June. Certainly, that's sort of the noises we're getting through from Canberra at the moment. In relation to JobKeeper, there is a lot of commentary in the media around Scott Morrison's comments, specifically in relation to it may be changed or amended or become industry specific in a certain way. And in terms of that, there is so much reporting that's happening in relation to the JobKeeper program that the ATO and the government have so much access, almost fortnightly in a lot of cases, of what you're earning and what you're paying your staff. So again, I don't think it's unreasonable that if you're in an industry or sector that has returned broadly to normal, or turnover is actually not down that much, and there are a lot of industries we're seeing that that's the case, that the government may turn the tap off in relation to the JobKeeper program. Now, in terms of this, obviously, we anticipate that the government will likely give a lot of notice in relation to this, but again, this remains to be seen. Also, in the QR codes there as well, if you download this slide, then you'll also get a link to the business.gov.au site. So not only are there federal government initiatives, there are a raft of local government and state government initiatives that are available to various practices. I know that there's many practices that we've looked after, healthcare practices that have had to close. Of course, all the dentists. In terms of this, they, in New South Wales, for example, have demonstrated in many circumstances a 75% drop in revenue, which has enabled them to claim a $10,000 state government grant, and many of those have been paid. So there's a great resource link in terms of that on the government business website, which will run through and outline the various state and local government grants that are available. Now, the next slide is actually quite a topical one, and it leads into my next commentary, which is that here's just the rough industry benchmarks in relation to, again, 4 key healthcare areas. And the reason that I raise a benchmark slide at this point in time is that's the next part of our discussions, because one of the most important things that every practice should be doing in the run-up to 30 June is you should be benchmarking your practice, because if you want to look at cash flow planning for the next 12 months and you want to look at how you're performing this year, then the only way you can, performance needs measurement, right? And there's no performance without measurement. And so so one of the other things we've been doing in a lot of our practices is benchmarking the practices basically up till the end of March. So looking at a 9-month benchmark this year compared to a 9-month benchmark last year to see actually how things were performing. We're also running some numbers in relation to these practices as well, now that they've reopened. I'll use dental again as an example. Now, the reason you also need to be across these benchmarks is that there's a whole lot of practices that won't align to these benchmarks, right? And that's okay. But what it should do is it should trigger the question to say, hi, accountant, answer me this question, why are my ratios out? Or at least consider internally why my ratio is not aligning to what the industry standards are. And again, it's fine if you do or if you don't. It's just understanding the why. Now, because good cash flow management and planning also understands how your practice is performing, okay? So what I'm going to do now is I'm going to move on to another slide, right? But what we'll actually jump to is we'll jump to a live sharing of my screen now. So, all right. So, in terms of this, what I'm going to run through with everyone now is just the kind of thing that you should be doing prior to 30 June and also prior to making the standard sort of decisions you should be making about investing in other assets, particularly if you were to deploy the $150,000 investment immediate write-off. Now, in terms of this, what I've got here is a typical sort of analytic that you should do. Now, I've pulled up a specialist here, obviously a reasonably successful specialist, and I'm looking here at the revenue numbers in terms of this over 2020, 2019, and 2018, okay? And I'm looking here at effectively the outgoing costs, and I can see here that in terms of a standard benchmark, we generally have 5 to 7% of facility cost, and we can see that this practice is broadly aligning to that. Then I might have supplies here, and I can see in terms of what we've got here, this practice seems to be, again, right in the middle of how things are tracking. Right? Might have advertising, seems to be at the higher end here. This specialist might be spending quite a lot of money to generate referrals and incoming patients and the like. Then again, I've got outgoings in terms of employment, one of these other categories, wages, employment, superannuation, contract workers, things like that. And then we have all of the minor and discretionary sort of outgoings in here. Now, we've got a few add-backs that's worthwhile noting in here. I've got some, again, equipment add-backs in and out in terms of the old thresholds. I've got interest paid. This might be practice loans, might be other things. Motor vehicle expenses. A lot of practices don't really need a vehicle, albeit a tax-deductible outgoing or expense. Subscriptions, things like that, which means that we've got outgoings here, minor and infrequent here, at around $136,000, which gives broad benchmarking, okay? And what we can see in terms of our profit here at 60 to 70% as being a benchmark for a specialist, here is coming in a little bit below that. And we can see it's coming a little bit below that because most of the costs that we've got here are at the higher end of the average in terms of this. But as a starting point, what we've got here in terms of this is we've taken basically estimate numbers. So we've taken the interim figures for probably the end of April, and we've run some estimate numbers out to the end of 2020. What's really important in terms of this is that what we have found in a lot of practices that we're doing some analytic on prior to 30 June is that when we overlay the JobKeeper payment in some of them, combined with cash flow boost, combined with a very quiet April, but again, looking at increasingly busy May, there's a lot of practices that aren't actually significantly down on prior years. And that's really, it's been quite surprising for a lot of people. Because if we look at a practice like this and we could say, okay, well, our wages fee was 140,000, and we could say in this instance, practice revenue, for example, might have had January, February, March at, again, say 80,000 every month, but then April was nil. And what that means is this practice here might have been eligible for the JobKeeper payment in full, okay? So if it did that, then this practice here might have been eligible for $20,000 or $30,000 worth of JobKeeper payment. And what that would be here in terms of that is it would be other income that would come in. Now, the reason why this sorts of data is important as we approach the end of the year is we can see here that this practice is still a very generous profit, not as big as it had been in prior years, but still a very generous profit. If I had JobKeeper coming in underneath that of another $60,000, or let's say in this example, say $15,000 a month, then in terms of that, that means profit. Oh, that didn't work, did it? Profit would be up significantly from the estimate numbers in there. Now, the next thing that needs to happen as part of this would be, it's important then to map these results across how you're doing from year to year, okay? Because in summary, what we've got here is income, expenses, and net profit. And what we can see, now I might make this one a bit larger, just for everyone. And this is the style of thing that should be being done before 30th of June when we're making these sorts of cash flow decisions. Because if I can see my income here mapped, okay, I can see my expenses pretty static. And then, of course, obviously, if my expenses are static and my income's going there, then up and down, then I can see my profit goes from here, up, and then down. And we can also have a look here about how we're also running across our industry standards in terms of how our expenses and outgoings are going. Now, part of this, of course, is critical, because what we might see is well, gosh, I can see here, well, promotional expenses are very high, right? But they seem to have been quite static from year to year, but they don't seem to be having a correlating effect on income. And if I see other things here, what these sorts of benchmarks get us to understand is that if there's variance in the way that we're operating our practice, because if we ask the question, there might be a very good answer, but until we ask the question, we're not exploring that. Now, the next step of this, of course, is to run the numbers that we've got, which we identified here, through a tax planning, because this has to happen before 30 June as well. So what we've got here is we've got, I hope everyone can see this. What we've got here is we've got a potential salary from some hospital work, the business profit coming in, okay. And I've got in here a superannuation amount of 25,000, presuming we do maximum superannuation, okay. And PAYG on the salary and wages there. And then I've got PAYG instalments paid throughout the year. So I've been paying quarterly tax instalments, okay. Now, what we've got here is we've got an outline of all of the payments that are going to be made, okay, over the next 12 months. Now, where this is really important, because this also comes into our cash flow planning and also the investment decisions that we're making, is we should then map these out, okay, across the next 12 months. Because these decisions around broad cash flow are critical, because when we're making decisions about investing in our practice or lifestyle decisions or the like, how can we make those decisions unless we know what our big outgoings are going to be in November? Right? If I know that in October and November I'm going to have outgoings that are really significant, but I mentally have to throw in there in terms of that, I might have to throw in holiday or school fees on top of this, and that might be, again, another amount. Then I might look at my outgoings in terms of November and go, wow, November's not going to be good. It's not going to be a good Christmas, right? Because I've got these other big items going through. Now, the reason why mapping your cash flow out in relation to taxation at least 12 months is that you need to plan at least 12 months in advance. So the starting point, and the reason why this is so critical, is that the starting point I've got is I've run my estimates for this year, okay, on what I think I'm going to do before the end of the year. Because if I'm going to make decisions around investment or the like prior to the end of the financial year, then I need to know what my financial year may be before I make that investment decision. And then what I should do is overlay how that will affect my taxes for the next 12 months. So if I look here, for example, we're looking at what we think our numbers are. We've graphed our performance here from over the last 3 years. Very, very sensibly, we've done that. We've got an idea on what we think our overall tax position will be, and this is still within the financial year before the end of the financial year. Right? And out of that, we've got a pretty good idea of what our taxes are going to be out for the next 12 months. Now, I'm continually surprised at the amount of clients we talk to that aren't doing these sorts of things, or people I talk, our clients do it, but in terms of people I talk to that aren't conducting this sort of sensible cash flows, because it's absolutely critical. And because this is the starting point, and as I noted, then underneath this really should be the lifestyle and family costs. So we should have, in terms of this, we should have home loans, business loans, school fees, holidays, all of those sorts of things should be under here as well, to get us a true understanding of what it is that our obligations are going to be. Now, what you'll also see here is I've put in place the cash flow boost payment in relation to this. So this is you can see that April, May, June, July, August, we've got payments from the government, okay, that offset PAYG. So that means April's a good month, May is not a good month, okay? Now, the final thing is, and it's critical because there's some good stuff out in the marketplace that that is providing finance, which again, BOQ are doing, but It enables acquiring things at the moment, but actually deferring payments for up to 12 months, which is really good stuff, on the proviso that the investment decision works. So I would never say go and borrow money or buy something unless it suited someone specifically after getting advice on it. But let's just throw in what we've got here. Let's say we went and bought something. Okay, we went and bought something big. Now, I'll take that out. Now, what we see here is that based on all the taxes we're paying, we're going to have a small refund or bill next year. We can see in our tax timeline that's payable there, 60,000 in August, etc., etc. Now, if I pop in an investment write-off, okay, what happens is as follows. We can see that we would end up with a huge refund of tax if we made all of these installments. Now, back to our tax timeline, if we did that, we would end up with a great big refund here in May next year. That's on the proviso that we did absolutely nothing. Now, who wants to buy a whole lot of equipment now, potentially on a deferred chattel mortgage or something like that, and get a refund in a year's time? That just doesn't make sense, does it? But we see it happen all the time. Because what should happen in terms of this is we go, all right, we worked out before the end of the financial year that this investment decision was going to yield a big tax refund. So what do? Proactively, we vary our instalment. Okay, so we said, you know, we don't need to pay this 60,000 for June. Okay, so what we're actually going to do is we're going to vary it down to 0. Now, we can legally do this with enough notice if we engage with the tax office. Okay, so what happens in terms of this is that this tax timeline here, that drops to 0. Okay. Now, what that means, it means that we're looking pretty good now in terms of all of our tax obligations. Oh, so no, apologies. This one here is payable. It's this one here that's varied to 0. Now, if we just lodge our tax return when we normally would in terms of this, okay, we get this refund here, and it's not the 71. The actual, I'll adjust this here manually. The refund drops to $11,000. But wouldn't we rather bring this refund all the way back here? Right? Because if we bring that all the way back here, we get it now, and then our forward installments drop from 63,000 down to 47. Right? So what we've done here is not only save an outgoing installment of 60,000, but we bring forward a tax refund of 11,500 in this instance, and we reduce our outgoing installments. Now, what's so important in terms of this before, again, 30 June, is mapping out what we think our profit's going to be, estimating what the tax is likely to be, overlaying some investment decisions in terms of this, or deduction decisions, and then seeing how that plugs out on our tax timeline, which is just critical for our household cash flow. Now, again, all of these decisions and the work that's involved in this sort of stuff, most practices are running some form of system like Xero. Most people are pretty well dumped MYB, but people are pretty well all on Xero now. Most of their information's live. Engagement and looking at this, and even if you don't engage someone to do it, but to just have a look at it yourself, all of these tax tables are available on the tax office website, and to run forward in terms of these tax flow and cash flow forecasts are really quite straightforward to do, and absolutely critical in terms of this for business planning. So I cannot recommend this stuff more highly. Now, there's both scenarios in terms of no investment and then making an investment in terms of the slides, and both of them are downloadable with the QR codes. I just think it's easier to talk through a live spreadsheet, but then I'm an accountant. Now, I'm just going to, all right, just go back to our slides, and I'll just pop in. Okay. There we are. So both of those scenarios that I ran through with an investment and not with an investment are located, again, with the QR code. In terms of this, all I would say now before I go into some Q&A is really just you've got to be, there's never been a more important time to be on top of all of the numbers. And that means being on top of the numbers on a daily or weekly timeline. I would encourage at the moment people to be on top of the numbers at least weekly. In terms of you need to have planning, you don't make investment decisions without a really good plan. In terms of that, as I also said, not only should a cash flow outgoing and forecast include the tax, it should include a personal and family going in. And again, it's not, a lot of people get very caught up in the minutiae of this, but a lot of this stuff is really quite straightforward and can be run out literally with a calculation on the back of an envelope, a lot of this stuff. Talk to your accountant again, and also if you wanted to make some investment decisions or big purchase decisions pre-30 June, absolutely talk to your lender. You need to be on the phone to BOQ like ASAP. And in terms of that, that's sort of really all I wanted to run through at the moment. Was simply just the benchmarking the numbers, the simple cash flows. This stuff is not, I would say it's never rocket science. I think it's quite straightforward. And what I might do now is, I guess with Tal and Tim, is just run through some Q&A if people have them. There's a couple of questions that are up already. And Anu has asked, considering a regular cash flow due to COVID-19, is chattel mortgage a better option to upfront purchases of larger equipment? Anu, I'm going to answer this with a tax answer before Tim might have some comment on the finance instrument. A chattel mortgage is the desired structure to buy equipment for taxation purposes, not a lease and not a hire purchase. It should always be a chattel mortgage to get the best tax result when you're getting an immediate write-off. So you're pretty well compelled to do a chattel mortgage or just a standard old-fashioned equipment loan. But in terms of the should you defer or not, to be honest, if you're getting a 12-month interest-free, payment-free deferral, I'd take it. I mean, this is, I'm not, I know I say this, this is not advice to act. So I'll click onto my disclaimer slide. This is not advice to act. All I would say is that I think if you've got an interest-free loan for 12 months with no repayments and you've cash flowed it and you're comfortable with it, I think it's a great idea. I really do. But on the proviso that you know that the repayments are going to start. Don't start utilising the bit of equipment, taking the money from it and expecting that you're not going to get the money at a later date. That's key. But Tim?
Yeah, I think just that key point there, Heath, is in terms of the instant asset write-off coming into end of June, you'll only be eligible to claim that if, for tax purposes, you own the goods, and you'd need a chattel mortgage for that. So a lease facility won't allow you to do that. That's why chattel mortgage is important. Yep,
absolutely. And Anu, does that, if you can just respond, does that sort of fully answer your question? I hope so. In terms of this, then I've got another question there from Kim Ching, which outlines, does the revenue of a GP include practice incentive payments? And this would be for determination of JobKeeper eligibility or also cash flow boost eligibility. Look, what we're seeing, so firstly, the answer is yes, it does. Right? That's the short answer. What we're seeing is that in relation to, there are a lot of practices, in certainly the general medicine sense, that are having to work longer hours to earn less. And that, again, is in relation to telehealth. It's the obligation of the bulk billing obligations and requirements throughout that. But what we're also seeing, though, too, is with increased volume and hours, albeit decreased margin, a lot of general medical practices are not seeing a big enough drop to get JobKeeper eligibility, and that drop in turnover needs to be 30%. There are a variety of different ways to do that calculation. The simple one is, what did I bill in April this year? What did I bill in April last year? And if I'm down 30%, then I have full eligibility. Now, I can make a JobKeeper claim through till the end of May, but until the end of, after that, I have to be on a month-by-month basis to make the claims. In relation to the cash flow boost payment, which is the PAYG credit, that's just a binary eligibility. Every business gets that was paying employees and remitting PAYG prior to the announcement of the legislation, which is basically prior to 29th. Was it a leap year this year? Yeah, prior to 29th Feb. So in terms of that, that's the obligation that they've put on everyone there. And I think that's about it in terms of other questions. Tal, Tim, any other questions?
I think maybe just if anyone has any other questions to ask, just click on that chat function on the right-hand side, and if you type in a question, you'll be able to send it through. Heath, I've probably got a question, and but firstly, just an observation. When you run through that tax timeline and you basically take out the $60,000 PAYG payment due in Q4 and bring that deduction forward, like that just makes complete sense.
Yeah, I think, and this is some of the deferred payment stuff is really powerful because you can get a real heck of a cash flow injection in your business. But the thing that we see all the time is that if people aren't on top of it, they do this good stuff that could reduce their tax obligations and don't take advantage of it.
Yes.
Right? Because you've got to be on top of it. And if you're going to go and make these investment decisions to really kickstart, or get advantage of this, get tax deduction, reduce your tax outgoings, then you tick every box. You don't do half of it and not all of it. And I know anecdotally, I've got a lot of clients with a little bit of extra time on their hands. So jump into the zero and tidy it up a bit and have a look at the numbers.
Okay. All right. I think that prompt, we might have had a couple more questions come through.
Yep. So we've got one there from Jennifer. What are your thoughts of using cash from your business to buy equipment for the instant asset write-off rather than borrowing money for it? And from a tax point of view, is it better to get a chattel mortgage? And what I would respond to that, I'd respond to that as follows: that it is very difficult to refinance equipment once you've paid cash for it and plugged it into the wall, right? So the way equipment finance, and Tim will have some comments on this as well, but the way I would always encourage people where possible to equipment finance, it's like cars, it's like all this sort of stuff. It's basically what we accountants call off-balance sheet finance. So in terms of that, the security is usually just the chattel, the good. It's the finance is very cheap. It's usually quite easy to get. And I would usually align the financial instrument, the lease or the loan term, to the useful life. So, for example, if I was doing a fit out in an office and the lease was 6 years, I'd probably finance it over 6 years because at the end of it, I might not want to be in that office anymore. Right? And I would, and a problem with, and also now, if you take finance out for something, once upon a time, there used to be interest penalties on paying out things early, once upon a time. Now, there's always still a bit of an administrative penalty for paying stuff out, depending on what the terms are, but those early payout penalties are pretty well gone, Tim, aren't they?
To a degree, Heath.
To a degree.
To a degree.
Depends on, okay, depends on the product.
Probably what I would say more on that is I agree that you should set it to the life of the goods. Yeah. But you can always take out a shorter term initially with a higher residual and keep your payments the same as they would be on a longer term. And then if you get to the end and you still want to keep going, then roll it for more time.
Sure.
That way you can ensure there's no penalty.
Yeah, look, from my perspective, I would say because you can get finance against these things, and this is not a plug for BOQ in any way or any financier, I would always keep my cash up my sleeve. And if I can finance a car or a bit of equipment, I would always do that because it's just, you don't know, you can't refinance this stuff at a late date most of the time. That's really the way the industry works, and it's not BOQ or Westpac or any bank. That's just generally how it works. And so I would always finance it, and then if I wanted to pay it out later, pay it out later. You've always got those options. We've got another question. If I bought equipment last week and I bought it already, can I put that into a chattel mortgage so I can get my money back and put it to another loan? Tim?
Yeah, absolutely. So yeah, Heath, definitely take your point before. For us, for BOQ, we can finance equipment secondhand or used up to 12 months old. So if you do decide to pay cash initially, or you have paid cash and you decide down the track that you would like to pull that money back out, we can do that.
Yep. And in terms of that, that's probably something that BOQ can do better than other people. It's traditionally very hard to get finance on equipment that's once it's plugged in. For benchmarking revenue, Kim's got another question. For benchmarking revenue and GP, does it include practice incentive payments? In terms of that, no, it doesn't. But they're meant to be very broad. These are the flags on the beach, sort of thing. Kim, if you need some help finessing some benchmarks, you can contact me.
I think Kim might have had one just a bit lower down that said if the service fee is not dropping more than 30%, are they not eligible?
Yeah, it's a very good question. So the ATO has released a position paper on this, because if the staff are still employed, technically the service fee is still payable. Now, the ATO has released a position paper on it. The position paper says that if, as part of this, I reduce my service fee by 30%, given the downturn, to get the eligibility for JobKeeper, and it's a related party, then in terms of that, the ATO has indicated it's low risk for an integrity measure. So low risk. So the advice that we're giving clients at the moment is that a big dental practice is a good example. Technically, if the staff are still employed, the service fees won't stop. They're still going to be paid if all the staff are still employed. If you choose to elect to drop the service fee by a large amount because of what's going on, and in terms of that, drop it by what you think the government incentive is going to be, the release on information paper from the tax office is that they believe it is low risk from an integrity measure, which is at the moment they're saying it's not 100% correct or okay, but most practices are proceeding on that basis. From my mind, I concur. I think it's low risk. I think what I would do though is make sure I've got documentation around it. So I would say that what are my invoices for the service fees to the practice say, and are all my invoices done? Do I have a service agreement in place? Like how good's my documentation? Because if they review this arrangement and there's no email chain between the service trust and the principal, even if it's the same person, you need to look at this as though the tax office doesn't know what's going on, and they're dealing with it as though it's a third party. So in terms of that, if you're dealing with a third party, there would be an email chain, there would be correspondence, it would be documented as to why the service fees dropped. So I would encourage you to do the same thing with your own practice if you're going to drop that. Yep.
Look, Heath, we're bang on 6:45, which is where I said we'd finish up. There's a couple more questions I can see around getting benchmark figures and a few others as well. Look, we'll come back to you individually on that and provide you some more information. I'm pretty sure we've got some benchmark figures on different specialties and give that to you. I think there was a question in there, Heath, around getting a copy of the Excel template. I'm sure
just contact us.
Put you in touch and you'd be able to help them out. Everyone, thanks for joining us. I really appreciate it. I understand it's after work on a Wednesday. It's time away from being away from work and also being away from your families as well. So thank you for joining us. In a fortnight's time, we will have another session. Tal Eloss from One Property Group will be hosting that to talk about all your commercial and residential property questions, including leasing commercial as well, and also his thoughts on the property market. And Heath will join us in that session on the Q&A if there are any sort of accounting questions that come up as a part of that. Once again, thanks for joining us and stay safe out there. Cheers.
Good night.